Hi, everybody, and welcome back to the Bear Trap Discord podcast. My name is John Kirby. My co-host is Vic. All chart credits, as always, go to Ak. This is the second part of episode 9, and this is where we made our projections for the week to come, which is now the week in retrospective. But that might prove useful for you guys anyway, because you can look and see which parts of our analysis were useful, which parts weren't, what was on the ball and what wasn't, and then it'll also give you an idea of what to look for this next monthly OPEX cycle. I'm still thinking about a lot of the things that we were discussing in the podcast, so hopefully all of you guys will too. In any case, like, subscribe, enjoy, etc. See you in the podcast.
Okay, so this right here, open interest, this is coming up for, like the main thing that stands out to me, I always check this first thing as soon as it's updated. And I always go to the biggest expiry, like which is the biggest expiry.
Right now we have February 17th, I would say.
Actually, I would say January 20th.
20th, yeah. It depends on the strike, but yeah.
Yeah. So, okay. So first things I note are like what is the biggest strike? Okay, overall, because you're looking at 50 DT here, biggest strike, and then what is the biggest expiry? So biggest strike here is going to be this 370 on a whole. And then the biggest expiry is going to be Friday coming up.
Yeah.
And then, so now what is the majority of folks, what is the majority of positioning right now? I mean, just looking at it from a naive perspective, because we don't really know what the positioning actually is, but we can make a pretty safe assumption that it's probably bearish, just based on put call ratio, where all the open interest is. It's pretty safe to assume that people are positioned bearish.
Yeah, I mean, I think it's kind of funny, like when you like a lot of the January 20th, there are way more calls in January 20th. If you go out to February, you can see that it's all puts, more or less.
Yeah, right. Yeah, there's more calls right now. As the market's been moving up, people are obviously they're going to start positioning. Because that's kind of new, I would say, the positioning into the calls. But it could be sold calls, though. You never really know what those are, right? Unless we look at, the GEX and the DEX, right? So those are going to give you a little bit more of a clarity there.
Yeah, I mean, the thing that I look at, and I hope that the SKU podcast kind of made this a little clearer, but if I want to know, hey, are those sells or buys primarily, then I do look at the SKU, right? Because the SKU will tell me where the risk is, which is essentially the same thing.
Yep, right. So let's look at this next chart, the GEX one. So I always look at just kind of the raw open interest, and then look at the GEX.
Yeah, because it's like the Greeks are kind of like filters on the open interest, so it makes a lot of sense to start with the open interest and then look at the various ways it can be interpreted.
Dude, I did a 13-minute video just on this open interest chart. So you can already make a ton of assumptions and a trade plan and everything without looking at anything else.
I agree.
The naive net open interest, but we want to get a little bit more clarity, get a little bit more rounded in our analysis. So yeah, let's look at the GEX.
All right.
Next. All right, so this is going to be, again, 50 DTE, our main expiries. And so the reason I care about this main expiry is why? Why do I care about that one?
Well, it has the most gamma.
Has the most gamma, and it's going to be doing what? Driving most of the flows, right?
Yeah.
Now, as we get closer to that day, and we're monitoring it every day and seeing the position changing, we'll have a really, really good sense. And it'll just become intuitive after a while, a really good sense of, who's offsides. And this is what we care about. We care about, who's offsides or who's driving the market into a certain direction. And in this case, I think a lot of what's happening and you can correct me if I'm wrong here, but a lot of what's happening into Friday is just going to be, as the market tries to go down, it's just going to be short covering, puts closing.
Yeah.
Because there's just a lot of supply. People have and this is where watching that new indicator that I was working on, basically it's tracking put calls and sells. And so this basically just showed me is like, man, if you come into a day where you've just got an oversupply of people just sitting in puts or calls, that's where you're going to get those. That's where you get those moves. Is just those people just having to get out of them.
Yeah.
Right. So right now we've got just an oversupply, especially compared to calls.
Well, and this is a little bit of a tangent, but so spot gamma, when they came up with their vol trigger, and we have vol triggers on our charts as well. The idea was, okay, under the vol trigger, then all of a sudden market makers are going to move. They're going to move with the volatility, right? So they're going to lean into expansions, lean into moves, and then above they're going to be suppressive of vol. And that's sort of a very rudimentary way to look at this, because
sure.
I mean, like you were just saying, hey, if we're entering into a day, like let's say we're under the total vol trigger, but we're entering into a day in which we're under that day's vol trigger, but there's a ton of puts underneath us, and the biggest puts are underneath, the biggest gamma strikes on the puts are underneath some lower gamma strikes on the puts. Well, as we go down, clearly those people are going to start to sell. So if you have to think about like the open interest and the gamma in terms of like the incentives of various market players, not just the market makers, right?
Right.
And that's going to tell you if we're going to be stifling or expanding volatility in a much more accurate way than just thinking about.
Under that vol trigger, the general idea is that the market makers, the dealers, are just going with the market. So if the market's weak, they're selling into weakness. If it's strong, they're buying into strength. And then vice versa above it, where they're selling strength and buying weakness, which is going to suppress volatility. So that's why they say the volatility expands under the trigger and gets suppressed above it. But like you said, it's rudimentary, because if you don't understand the positioning, then you're going to be caught off sides a lot of times, because it's not that simple. If it was that simple, where you just had a single line on a chart and you just knew it was a sell underneath and
everybody would be making mean reversion trades above the vol trigger, and everybody would be making expansion trades underneath.
I say the vol trigger is more like a magnet itself in most cases, and the market is essentially trying to find a reason to get back to it.
Yeah, and I mean the reason for that, and this will go directly back to the positioning, is that, okay, let's say you're holding out of the monies. At some point, you're more likely to sell those out of the monies than not. When you sell the out of the monies, it by default pushes us back into the vol trigger, which is by default between the out of the monies.
Exactly. So So if you understand the edges, kind of like what you've been playing as the boundaries. If you know where the boundaries are as far as options positioning goes, that's where you can start understanding how time is going to be affected and how volatility is going to affect those positions. And then you can start visualizing how the delta contracts around a certain level. So like in this case, the delta is most likely going to start contracting around the 400 level. It's pretty plain.
Yeah.
And this is for the next 50. This is just for the next week. And so what happens to all these positions if the market closes here at the end of the week around 400? Everything expires worthless, right?
Yeah.
For the most part. And then they could even close this at 399.50, and all those 400s are dead too.
Yeah, the only thing is that we do have, right, like this positioning is going to shift pretty radically this week because of the VIXEX and the OPEX, right? That is this week still, right? Because it's the 16th.
Yeah.
And then the 20th is Friday.
So that's another thing too, is keeping that in mind. The VIX, right? We have to know where the VIX what the VIX is trying to do. And so let's pull up a VIX GEX chart. If we can grab one of those.
Yeah.
Because that for me has been so key. I don't care if anybody says don't GEX the VIX, and I've said this a million times. I don't care how many times you say that. I look at that VIX GEX every day, and that thing is accurate to the freaking penny, man. Like, this thing is so accurate. And understanding the positioning in the VIX is so key to knowing what's going to happen in SPY options or SPX.
Well, and this is something that I've been wondering about, because I agree 100%, and like this is what I like. In addition to the skew, this is what I'm relying on, sorry, to give me that sort of like I call it like the seasonality of volatility. It just has these natural cycles, and that's one of the things, the sort of like the market timing things that I love the most. What is amazing to me though is that when I think about it in terms of notional value, it's not that high up there. You know what I mean? Like, what are you like? I mean, in this we don't see it directly here because this isn't net open interest or anything like that. But I mean, these are pretty like it's like 20, and then we're looking at a 75 million. If you compare that to the GEX that you get on a SPY in a day, it's way more. It's just that for whatever reason, it seems like, what is this, like professional positioning or something like that?
I would say what I really want to know about what's happening in the VIX is there, because the key that I've learned from Gem is there a supply or is there demand?
Yeah.
And that's kind of what I read off it. You know, you don't look at it like a normal GEX like on a SPY, but what it's telling me is that, you know, positioning in the VIX right now is, you know, people are just overloaded with hedges. And they're starting to position to the upside. You can start seeing that. And those positions are going into February and March.
Yeah.
Which, again, they're hedging again, which they should. But in the short term, what we're looking at is at least into Wednesday, when all this GEX expires, we're looking at basically some more volatility suppression. And even if it goes away, which it will, you may get some sell coming in. But you just look at the next expiry for VIX and go, okay, here's what the demand or supply looks like for puts. And then you can start making some assumptions and inferences on those open interest positions based on what volatility is going to do, at least. Because the time part is easy, right? Because if you're looking at 1 or 2 days out, you've already got the time component because all you got to do is wait for the end of the day, or you can already tell, you know, because the expiry is happening. But the volatility component is the other key. Are the calls going to get squeezed because of vol, or are the puts going to get squeezed because of the vol?
So when you say that you see supply and demand off of the VIX net GEX, how do you what are you looking at?
Well, okay, so just you know, my thinking is like in this case, okay, there's just a ton of gamma here at this 19. Yep. And 20, and you know, that basically just tells me that there's no demand for hedging right now into the expiry. Nobody's adding to hedges. Nobody's buying puts. And I think that's a function of everybody is already in puts. And so they only have puts to sell. They have only have puts
just for everybody to clarify, the puts that Vic is referring to are puts on SPX and SPY and so forth. Not
you have to know what the VIX is actually calculating, right? So the VIX is calculating, essentially you look at it like it's looking at demand for SPX options.
Yep.
Right. So I had this way of saying, like, it's kind of like an RSI of like a relative strength index of SPX options. And like, if you're going to think of it like an RSI, I would say VIX is starting to hit those lower bounds of RSI. Like you're getting under 20 or whatever your number is.
Yeah. And so, I see how you're looking at this.
Good. Okay. So I'm thinking,
and I don't disagree with it. I would say that, like, obviously it's not right. There's no direct connection, right? Because when we're looking at VIX net GEX, we're looking at options on the VIX. Like the direct connection would be looking at the VIX index itself, but you know, they serve as a really, really good proxy for what you're trying to read anyway.
What I'm trying to read is I want to see what the demand is for hedging in SPX into the next expiry, right?
Yeah, and there is definitely virtually none here, right? Because it's all on the put side in the VIX.
Exactly.
They all think that vol is going to be suppressed into the expiry. And then the other thing to think about, right? And I'm sure, I mean, like we've talked about this before, right? As soon as all these guys go away, it almost acts as if all these things that are pushing volatility down have come off, and then it'll just release us to let us go back to the upside in volatility.
Yeah, exactly. So right now you're building the, you know, you're pulling the rubber band back.
Yeah.
You know, and you're getting to the end of where the rubber band is almost stretched as far as it can go, and then you're going to get that release. And you know, who knows? You probably will sell on Wednesday, You'll probably be somewhere around that 410 SPY or whatever. And then,
Well, yeah, that goes into the next thing I wanted to talk about, which is if we are going to get a serious sell, and this is what I was, sorry, let me get back on the, over here. Yeah, okay. So if we're going to get a serious sell, as we were looking at on the net OI, like we have actually right now, and this is concerning me a little bit, too many puts, because I mean, I want us to sell off a bit, too many puts for February 17th on the books already.
but the other thing is how far away they are too. So you could get a really nice sell from these upper levels, and you still, cuck those, 370s and 380s from.
But the short only comes off the squeeze. Like in order for that to be a viable short, we do need to squeeze up to 410, and we need the bullish flip to happen first. Then these guys need to kind of start to become a little less relevant, and then we can really get the sell-off.
Yeah, and so the keys for me, at least looking forward, is obviously where is price going to go? Because if we start heading lower and we start getting closer to those levels, they could start acting as magnets. But right now they're repellents because they're so far away. And as we get closer to the expiries, as we get closer to Friday, so like my plan for this week was essentially be like, hey, we'll probably move up into 406, 410 by Wednesday. If we can get over 400, and even if we just sat at 400 for the next couple of days, and then we'll probably get a nice little sell as the VIX releases. And then you probably get a huge buy into the expiry, as all those puts, basically realize their fate and that they're probably not going to get paid out without some, 2 or 3
I like that way of putting it, as they realize their fate.
Yeah, and so they'll wake up on Thursday, and we may be at a low on Thursday. We close at the lows, but it's not low enough, and so you just wake up and you just go, well, screw it. I'll just roll these hedges out, or just close them all out, call it a day. That's usually what ends up happening, and what I love about it is a lot of times these moves were inexplicable to me, but now I have a way of at least framing them.
No, I mean, and we see them, there's always going to be some uncertainty, but we see them brewing ahead of time, substantially ahead of time.
Right.
Okay, let's move on to the decks, because this is something that we really wanted to get back into today, I think.
Yeah, for sure.
Okay, so what is this?
So we're looking at basically, I've been trying to keep these DEX charts to the simplest I could possibly do, and I'm really just looking at where the positive delta is.
Mm-hmm.
I don't want to try to I just make a super naive assumption, and maybe someday when we get more data sources, we can start breaking this out into what the actual positioning is. But I just make a naive assumption as to where the delta is, because if we hit that 390, just for example, what does that mean for anybody that's positive delta? Essentially, the market is net positive delta there. What would happen if price went below it?
It means that all those positive hedges can come off, meaning that we can start to really go down. That's like the inflection point of falling off of a cliff.
Right. So what ends up happening is the reverse flows, they start becoming negative, essentially.
But this also tells me, sorry to interrupt, but this also tells me that so long as we stay above 390, we're actually okay. We can come back down to the 395 region, and that's not really cause for concern.
And this is what tells me, if I see positive gamma above and I see positive delta below,
mm-hmm.
It's really hard for me to be bearish. Especially if I see a setup like this. Really, you just need the 3 charts. You need the VIX, the GAX, and the DEX. And you go, well, we're positive delta, we're positive gamma, and the VIX is negative gamma.
Yep.
So it's there's the 3 horsemen here of bullishness, because you're fighting against all the flow. You got triple flow here.
I love it. Yeah.
So I use the DEX simply as go, okay, where's my inflection point here? You can see the distribution of positive delta here. The inflection point is clearly this 390. So as long as we're above the 390, we're in this positive delta environment. As long as the GEX is on my side, it's positive GEX, then, and it would have to be significantly negative GEX to get us down there, I would think, because there's quite a bit of positive delta in between where we are now. And you can sort of see, like if you just look at it as a distribution, you can sort of see there's been no tail on the delta distribution. You know, we're kind of like creating one, but to the upside, it would be weird to just stop here without feeling the tail in on those delta curves. Do you know what I mean?
Yeah. Yeah, no, I do. It's basically like, okay, so I'll break it down for people who are looking at the chart.
Yeah.
Currently, we're at 398.46, right? And then if you look, these are the delta hedging curves, the ones, the kind of rainbow colored bands over here. And there's kind of like a hollow until the delta hedging curve becomes like hits the, what would you call this? I guess the y-axis, which is kind of in the center here of our histogram. And that hollow kind of needs to get filled up before we can start to come back down. Is that a fair representation?
That's it. So that GEX is kind of leading where the deltas are going to end up being, is what I think of it as. So like I said, again, it's like, well, it would be really hard for me to see us selling significantly into Wednesday, given the way the VIX is set up, the way the SPY is set up, as far as GEX and DEX. It'd be very strange. So it'd have to be some kind of tail event, which is possible given the way skew is, but
which we'll get into shortly. But
yeah. But the way the positioning is already set up, I feel like the setup for the huge sell is going to be this super low skew and nobody's hedged.
Yeah.
That's when you're going, okay, let's sell this thing off.
Well, and this is part of it's these types of charts. So actually, it's funny because I don't usually read this off the DEX. What I look at is I look at the net OI actually, and so I look down here and I see this clustering right here, right? And if you pay attention, the 390s are right here, so it's kind of right at the top of where all that clustering starts. And then if you go over to the net DEX, you can see, okay, the 390s right here, and then you have some stuff above it. But really what this is, the net DEX is just telling you, oh, these puts are hedged right here.
And that goes back to my point to where if you start with the raw net OI chart, and then you add some clarity into it with your DEX and with your GEX, well, now you have a really good idea of what the positioning really is.
Yeah.
Right?
No, I totally agree. So basically what'll happen for me is if we're at the right time in the expiration cycle and I'm looking at a net OI that looks like this, I'll be like, okay, I don't mind selling puts into this. Like we would have to have a real mess of things happen to get under 380 here. And then, equivalently, I could just be looking at the DEX and be like, oh, hey, look at all these positive deltas that are accumulated underneath us. Until we breach this level, those are all sort of static positive flows in a sense, right?
Correct. Yeah. Yeah. And those are that's basically how you want to look at it. So what's your risk here? Your risk of a cascading event is under the 390, which is again totally possible. I don't want to discount that as a possibility, and I would welcome it.
Oh, I think it's going to happen, but I think that the path there is complex. Like I said, we need to have a blow off at 410 first. We need to clear some of that inventory. And I mean, a lot of this inventory on the DEX is there, right? Because it is all January 20th. Right. So if we get a blow off 410 for January 20th, we clear out all of this DEX stuff, then actually we start to have that path down.
Let's look at the skew.
Yeah. Okay. We got to do that too. Okay.
Yeah. So yeah, the skew.
Why the hell did I got SPX for some
reason? Pull SPY up for the next, just for like the next. I don't know if you can do it for just the next week or something, but I don't want to look at it for this many expiries.
I mean, the reason that I can grab it. This is as of today's the 16th. Okay, this will be. Here we go. Okay, so this is not. We don't have an expiry sorting function for the skews yet.
Oh, that looks better though.
But yeah, SPY is usually a little better, and then I'm pretty good at figuring out which line is which at this point because I just kind of have an intuition for it.
So what are you seeing? What are you seeing on this chart?
Okay, here's what's cool, and I haven't seen this in a while. If you look at so this guy, the really messy guy all the way up here, this is your 0 DTE because it's all screwed up, right? In other words, like vols were going a little crazy. The smoothing didn't really work properly. We have these big bid-ask spread because that's what happens at the close. Basically, like market makers just send out wide quotes just in case they're casting a wide net. Anyway, so disregard this upper line for that reason. So the next guy, January 17th, our 4 DTE is this skew right here, right at the bottom. You see where I'm putting my mouse kind of?
Yeah.
Okay. So if you notice, this is like it's like more significant put skew than any of the other expiries, which just tells me all those puts that people bought, which we saw in the net OI that they're in, they have many vol points to go down. Because think about it like this. Okay, so these out of the monies right here, they're at a 20 vol, right? And VIX is at 18. VIX is is unlikely to go up until after VIXpiration. And so the value of these puts, or the implied vol of these puts, is also actually going to decay as we get into VIXpiration, and it's going to just come down. And so that's actually going to force us up in terms of it's going to force price up. So the 4 DTE skew is saying is supporting our thesis that we were seeing with the gamma, with the GEX and everything, that we're going to head up to 410. But okay, if you start to move out to the later expiries, which is this sort of red cluster in here, you can see that it's incrementally less put skewed, right?
It's flatter.
Right? Yeah, it's flatter. The calls are getting bid a little bit over here. And then if you look at the longer term, it's way, way, way flat, which is actually, that's what I would call a scary skew.
A scary skew. So if you look at skew a lot, and you obviously look at this and you go, why is basically what the market is doing is it's pricing in, it's basically, it's what do they call it? Platykurtic, because it's so flat. Platykurtic, yeah. So they're basically, there's like leptokurtic, and then there's mesokurtic and platykurtic, which is with a flat version of it. And they're pricing in, a wide array of probabilities.
Yes, for the longer term, yeah.
Yeah. So you're in a situation where the market is already expecting something. That's the way I look at it as. It's flat, which means there's not a lot of nobody offsides really. If anybody's offsides, it's probably hedges. It's probably it's probably longs because they're not hedged properly. But the market is essentially expecting a lot of different probabilities. They're what do they call it? Dispersion in the market right now.
Yeah, and I mean the reason
that
that it's a scary skew from sort of a like that, I almost tend to look at this as a bearish skew. It's not saying that we're going to go down.
Oh, for sure, it's bearish to me, but it's not. It's just not bearish in the sense that we are going to go down. That's what
it's just saying that the vulnerability is there. And the reason is, right, so like this entire year, when I refer to sort of like the, not calendar year, but, let's say the last few months since Ukraine, all of that, right, we have been in a bearish situation. We're still in QT. Let me just, we can all, I think, agree that the fundamentals are bearish. And so when you see a flat skew into a fundamentally bearish picture with a market overextended to the upside, that's not a rosy situation.
Yeah, so looking at this, I would what does this go out to April? I would want to see like the March and April skews start to shrink in a little bit from those tails, because in my opinion, it looks like the market is pricing in tails. They're not pricing them that much because the vol is really low, but given that it's so flat and so wide, market is really uncertain, and it's pricing in tails. Like there's no opportunity for tail event here. That's basically what I'm looking at it as. Like where you were talking about the skew coming up, look at the difference between the skew you were talking about where we're pricing in puts versus the way the skew looks for March and April.
Yeah.
It's very, 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 very different. That's what you'd want to see you'd want to see something like that to the downside or upside, but you'd also want this to be to shrink in a little bit. And I think that's when you're going to start seeing the tail events come in. And it's not going to be a tail event like it's going to be like apocalypse. It's just going to be really, it's just going to be a positioning event.
I want to put a little bit of pressure on that idea that we are pricing in tails on the longer expiries, because at least my interpretation of the fact that we have these sort of like longer lines, if that's what you're seeing, is that when we go into longer expiries, we have more strikes. And so we just have more skew, like more points, more implied vol points to add to the skew to make this line longer, so to speak. Unless that's not what you were talking about.
No, sure. Okay, so no, that's good. So as price moves up and down this line, what's going to end up happening?
Well, honestly, if price were to continue moving up, I don't think that the skew could get that much flatter. It would just overall, it would stay the same level of flatness, but it would just come down. So you'd go from having a 30 vol at the peak puts over here to having a 25 kind of. The entire complex would sort of move down.
So okay. So is it better to be a seller of premium in a skew like this or a buyer?
I mean, let me think about it. Okay. So in order to answer that question, let me go through the second scenario. Like, let's say that price moves down, right? If price moves down, then this, like, let's talk about this April skew is going to start to look more like the 4 DTE skew, where the put side is actually going to come up and maybe start to hit the 35, 40 vol. And then the call side is just kind of fall off a cliff here a little bit more, but not that much, right? So the put side is going to go up more than the call side is going to come down if we go down. So if we have a bullish picture, I'm trying to think about what that means in the sense of what you should be buying. I think it's not a bad time to buy far out put protection. If you are, it's
not how far out though.
I mean,
not as far as expiry goes, but I'm talking about out the money.
Oh.
How far down do you buy your puts?
I think I would want to rely on these sort of historical vol lines to look at. I'd want to get something that's like a historical 30-day, 60-day historical vol, something like that. So maybe I would go down to 375, for instance, and then out in March or something.
Okay.
If I were trying to get the best bang for my buck, in terms
if you're hedging.
Right? Yeah, if I'm hedging, correct. Yeah.
So why aren't people doing that then? Because it's clear. It's clear that skew right now is cheap. Like puts are cheap.
Well, it is and it isn't, right? Because, okay, we have to remember that, like, let's say that all of a sudden the Fed does pivot, right? And then we're looking at a 15 VIX again, right? This is still, from the perspective of, like, from a historical perspective, having this like a, 30 vol up here, a 20 vol down here, this is still pretty high for puts. And so the scenario, it's almost like people are afraid of, and I think this accords with what you were saying about how we're pricing in a range of possibilities. We're kind of at this inflection point where people aren't sure, should we start to get bullish again? Like, are we going to go up to, 4,500 type of bullish, where like that's literally what we're looking at right now? Or are we still in a bear market? Like, that's the inflection point that this skew is telling me that we're at.
Okay. No, that's fair enough. So if again, we go back to, is it better to sell premium right now or to be long premium? And, whether you're long calls or puts doesn't really matter that much. But would you be a seller here in general?
I think if you wanted to do the best of both, would I? No. I wouldn't get in front of this. Not right now.
As far as selling premium?
No, I would basically wait. Okay, because there's two scenarios, right? Like, let's say that if we beat 410 and we stay above it, then you can definitely start selling again, right? Because then just the and you're not even looking for as much implied vol compression there. You're mostly just looking to sell deltas. But the thing is, if we're underneath 410 and we come, then we have a direct path, like you were seeing, all the way down to 390 at least. And then you'd have to see how the positioning would adjust. And maybe then you'd sell some premium.
So if we, it's funny because it's like if we look at a situation where the market is in this flat skew, but it's still high, then the market is already expecting a wide range of probabilities. And it sort of seems like that's a mean reverting type of environment.
I see what you're saying. Like, I see what you're driving at.
So if it's right, if this supposition is right, then it is better to actually be a net seller of premium. Sort of like what you were doing. You were selling premium into the end of the year, and you took a little bit of heat, but not a lot. Why? Because the market was already expecting that range. And so all that ended up happening was we tested the lower end and then we reverted back.
Well, I mean, I kind of want to, I'm not sure if that's entirely accurate, because when I sold these things, the market was expecting us to dive off of a cliff. In the sense that, right, the skew looked more like the 4 DTE skew, where you have massive put skew.
Not the March and Aprils, though.
No, not the, but I wasn't selling March and Aprils, I sold January's.
So if I would say we're using the March and April as an anchor point for the skew.
Yeah.
And so when your other skews get out of whack, that's kind of how that's how I've been kind of gauging, like, okay,
yeah,
the skew's going to sort of tend towards to try and look like these longer dated ones. Given that there's probably not a lot of positioning in those dates just yet either, but it's definitely a different look than what you saw. Like, I wish I could pull up a chart from, like, say, before summer 2022. It was a lot different look. And even after summer, they started looking a little bit different. And then maybe around, like, I feel like the skew started looking like this maybe around like September, October. You started seeing this flattening.
Mm-hmm.
And this always goes back to, like, okay, so Jim Carson, he's always talking about how there's just this oversupply of vol, right? And it's never working for people. And so what is happening when people they're just not hedging like they used to, right? So this is what's happening to the skew, is it's just getting destroyed because people are like, well, screw buying hedges. And at this point, everybody's getting rid of their hedges for the most part.
Mm-hmm.
And so you're seeing this skew drop down to whatever it is. I don't even know how you measure that. It's the 0 percentile, but it's obviously been dropping and dropping and dropping as far as just the level of volatility that the entire skew is at. And then also the tails as well are dropping because, folks are pricing it in, but they're not pricing it in with hedging.
Vic, I agree with your read on the, like, sentiment related to the skew and all of these things. The reason I'm saying I wouldn't sell puts into this is because if you wanted to do anything, you would want to, buy puts on the VIX, for instance. I mean, it's a little late now, but you know what I mean, right? Like, you'd want to trade the downside on implied vols all the way across the curve.
Right.
But if you're selling a put, at 360 or 380 or whatever, your risk for a tail event is actually higher when we're looking at this flat skew, because you have the risk that
I agree.
We have a catalyst of some kind, and then all of a sudden there's a ton of in the money puts, and people can just keep adding. I mean, that's what we saw with the COVID crash, right? Where it's like, what ended up happening was that people that were in the puts would get in the money so fast, and the movement was so strong that you'd actually just roll them down. And so you continually roll them. And so you don't get this buffering effect of vol and puts. Instead, you actually get an amplification effect. And that is the main thing you want to avoid as a put seller.
I agree. So I agree with you on that. As far as if you were looking at the March and April expiries, I would not be, don't get me wrong there, because I would not be short premium into those expiries. Personally, you may still get a reduction in the overall skew as far as the vol goes, but I don't know if that risk reward is really worth it. But I would say until then, these shorter skews, I think you should be I think it's a better risk reward to be a net seller.
Oh, the shorter skews, yeah, like everything, literally everything in January.
Yeah.
Because look at how you have some pretty decent put skew. And so long as you're selling underneath that 390 on SPY, like we were talking about.
Especially if these skews, if they pop up, above the historicals, or especially above the like the IV90, and then you should probably be playing the mean reversion situation.
Yeah,
Because I think
until
that's what you're doing. You're going, okay, look, I'm ready to sell some in the money calls at this point.
oh yeah, yeah. Well, because I feel more comfortable doing that right now because it's like I mean mostly because of the January expiry. The thing is, I think that like that call is fair to make until the end of the week, right? So like, okay, let's sell some 380s for Friday. Okay, no problem. But what the hell is going to happen once we get the reshuffling after the monthly OPEX? Then we're going to have to come back to the skew again and reevaluate the whole thing.
Yeah. And so, and for anybody watching, I mean, this is just basically the process you have to go through. And I would say, it helps to find someone you can bounce ideas off of and start to, develop a full picture. You don't have to trade the picture that you develop, but on a day-to-day basis, I mean, it definitely helps me to have the full context, at least have an idea of what the full picture looks like,
No, and today changed my views on some things because I was a lot more, I have to say, before I took a look at all these charts this weekend, I was a lot more bearish with regards to after this monthly OPEX. And now looking at that delta hedging chart, it's not that I'm less bearish, but I do have a little bit of pause where I'm thinking, okay, let me reevaluate after that OI has reshuffled because it might not be this immediate sell that I was thinking it was going to be.
And that's the other thing too, is getting the timing right. Because how many times have you been right, but you were early? You know what I mean? Like, you're right about things being bearish. Everybody is. I mean, things are not rosy. We're staring at a recession. We're probably looking at tons of job losses soon. The car market's about to crash. The housing market's in danger. Things aren't rosy, but you're most likely going to be early. You have to just be ready to accept that. And it can go up. The market can be irrational for what? Longer than you can remain solvent. Right? You hear that all the time. And this happened to a buddy of mine. He actually was extremely short. Like, he was over leveraged short February of 2020 for whatever reason. I don't remember what his main thesis was or whatever, but he had to cover margin call wise, literally like a week before the crash.
Oh my God.
Because he was just early, right? So, he didn't have all, the tools that we had, nor did I think he could understand them yet. But it's like, if you at least have a way to be like, okay, like you said, give me pause here a little bit because maybe I'm a little early, right? Maybe I need to wait for that VIXEX to happen, or maybe I need to wait for OPEX, because if you look at the March 2020 crash, it was literally like Feb OPEX to March OPEX.
Yep.
That was the crash. It was like to the day. So don't discount, not for you, obviously you understand the importance. Don't discount, anybody listening, don't discount the importance of the expirations, because everything that's happening right now is just a shuffling of positioning.
Yeah. And I think also something that I definitely tend to underestimate, and I think a lot of us underestimate, and this is something that, Paul Duncan from Gamma Edge has pointed out, and he pointed out during our podcast with them, is that a lot of this positioning is what I would call thick, right? It takes time and a lot of work to unwind it. It's not
Right.
just like this, zero DTE, I'm going to just liquidate everything.
Yeah.
And I mean, that's why some of these effects, for instance, like what I would call the gamma squeeze, or actually not a gamma squeeze, the delta squeeze, or the put monetization that happened in big tech over the course of the last 2 or 3 weeks, they were like, at least with, let me use Microsoft as an example. There were a lot of people with in the money Microsoft 240s for January, end of January, now the 20th.
Mm-hmm.
And on those first few legs of, we had like 2% up moves or whatever in Microsoft, it's not like they all got out of them. A lot of them were
No.
bag holding those because those things
Yep.
are wound up with a lot of other positions as well. And
Yep.
now I'm finally starting to see some of these things come off, but it takes time.
Yeah.
That's why we look at the VIX the way that we do. It's because these hedges are representative of larger positions that are elsewhere. We might not even be seeing them. Maybe we're only looking at the tip of the iceberg, but
You
we're
are
looking
only
at the
looking
important
at the
tip. Yeah.
You're looking at essentially like the symptoms of what's really going on under the surface. And it's one of those things where you go back to the liquidity thing too. And I've been really trying to figure out how I can measure liquidity in the market, because that's the main driver of all of this, is how much liquidity there is. And Jen talks about this all the time. There's $450 trillion worth of assets. So if you just add everything up in the world, and everybody's trying to hedge in SPX.
Yeah.
They're trying to buy insurance on SPX for 450 trillion. So the notional value that you trade every day is like really like just a couple $2 billion of actual notional value that's moving the markets. So if you think of it in that sense, where you've got 450 trillion and you're really only taking a very small fraction to move the markets every day, it takes a while for this stuff to happen because they can't come into the market and sell all their Apple shares.
No, they literally wouldn't be able to do it.
They couldn't. Yeah, there would be zero bid. So
it reminds me of the FTX Alameda thing, right? Where it was like they were valuing their own currency at X, Y, or Z, and then, but the problem is that like they were the only buyers of their own currency. So
the next day they're worth nothing, right? Literally, that could happen to the market if if it came down to where everybody had to rush to the exits at the same time. It could be over like that, just in a split second, because that's how over leveraged the system is, and that's how little insurance people can actually buy for their assets, because everybody's long the market. And it's just such a good way to think about it, because it's like if you own a house, you're long the market because you want the house to go up. If you work, you're long the market because you want wages to go up. You want to keep your job. So everybody has an interest in the market going up. And the only way to protect yourself is to buy puts or, buy some sort of hedge. And most of that is going to be in SPX, because it's really the biggest, thickest market out there that you could do that with. So with that in mind, it's like the liquidity is the biggest issue. And that goes back to your point where it just takes time to get out of this stuff. They can't, if they're buying hedges, they can't buy all the hedges that they want in one day. So that's why you got to track it every day. You got to look at it. Okay, well, look, they added here, they took away here. And then you got to make some pretty broad inferences on what's actually happening. But that's, again, where you look at each aspect, as neutral and unbiased as you can, and just make a judgment call based on the evidence. We're looking at the evidence here. I mean, the only thing we can really say is that we're at least flat to bullish into Wednesday. This is what we're pretty sure about, and we have some pretty good reference levels.
After Wednesday, and in particular after Friday, we do expect a moderate pullback. I think that's fair to say. Something over 390, and then after Friday, that 390 level could change. So then we'll reassess the 390 and see.
Yeah, because you got to think about these deltas. They're expiring too. They don't need these deltas.
No, that's what I was going to say. These are all Jan 20th deltas. So that's where I could see a little bit of explosiveness come into play. But I mean, we still have all this, all these puts. Like if you get to 390, all of a sudden all these put strikes out here in February. I mean, still we have time until February, so you could have like maybe a couple weeks of even coming further down. But at that point, these 380s start to catch us, right?
Yep. Yeah. So man, some great stuff here. And hopefully people learn a few tricks to just help themselves out, or you could basically go, screw all this. I just want to learn how to trade a moving average crossover, because this could definitely throw you off. But I would say the key for me has been just combining the GEX, OI, the DEX, and the skew, and then looking at the VIX. So you got like got 5 things to look at. If you just wrap your head around those 5 things, you'll have a pretty good idea of what the market's going to do. On a time basis and a volatility basis. Okay, because it's all about the time, volatility, and the positioning. And if you can at least wrap your head around, get an idea of what could occur and why, um, it'll definitely help you out. So
Yeah,
yeah,
and
I'm excited to see what this all looks like
I think
at the
Vic,
end of February.
since we have pretty well nailed down, okay, what are the different parts of the system? I've done a podcast on skew. I mean, I'm sure I could do more, but I've done like the fundamentals of skew podcast. We can
Mhm.
add a fundamentals of DEX, fundamentals of GEX,
Yeah.
and then just have the whatever. What did you call it? Like the three horsemen or whatever?
I don't know why I
Four
said that,
horsemen?
but yeah, the 3 or 4 horsemen of something, man. I was trying to come up with some kind of moniker for something, but yeah, I mean, it's really the five pillars here of kind of getting a 360 view.
They're gonna be like, can't you guys even get one number straight? Like,
I know, right? I know. If I was like trying to create a course or something for people, I would probably, obviously nail some of this down, but I'm way too lazy for that because I really just want to trade. And yeah.
no, I mean, I know for like my experience at least was I learned the most from listening to podcasts like this, where it's like, you have to do a little work to sort through the stuff, but also it's people just being honest because they're not filtering everything.
Yeah, no, and my whole goal, man, whenever I started my YouTube was really I just wanted to just give people ideas on, you know, let people know how I'm doing and how I'm trading stuff. You don't have to do it like me, just like you have a totally different style than I do, and it's an infinite game, so you can trade however you want to, really, as long as you develop yourself an edge of some sort. This right here is edge. This is stuff that 99% of folks are not looking at. So right there, if you have any kind of understanding here, then you already have an edge that most people don't. I mean, the big banks probably all look at it, but it's like I've talked to institutional guys. They have no idea what I'm talking about when I'm looking at this stuff. They're trading
Yeah,
they're
it's
trading
it's
freaking
amazing.
RSI and VWAP strategies, and it's like, well, that stuff is like classic cookie cutter retail stuff.
Well, and even the quants that do, and I was talking to Jazz from he has that tool in NFA. What do they call it? I think it's just called GexBot, honestly. Um, and anyhow, I was talking to him, and we were mentioning how even a lot of the quant guys, what happens is they have a tendency to assert that there's no edge, right? Like that as a retail trader, you can't get any edge. But I think that a lot of times that happens because what they're exposed to is they're seeing how quickly their transactions happen, how their software is sort of seamless in this kind of beautiful way, how they're trading many markets at once. But the part that they don't see, because they're so involved in that, or because, as market makers, you have your algorithms that's, they're pricing all their forward vols and you're correcting to make sure that your forward vols are all in line and whatever. What you're not seeing is this sort of like, what is the big picture of the gamma world? Because you don't need to see it because your edges come from somewhere else. You don't
Yep.
care.
Yep. No.
Um,
No, dude. No. There's if they say retail doesn't have an edge, that's ridiculous because I can go into NinjaTrader right now and create edge with one moving average. I can back test the moving average, and there's instantly an edge there. It might not be a great edge, but I can promise you I could find a profitable strategy with a single moving average. And so if that's possible, then there's edge everywhere. There's literally unlimited edge.
yeah,
And
it's
yeah, I
just kind
think
of a,
yeah,
it's, I mean, yeah, it just ends up being complicated once you start to factor in, and maybe this de-edges the edge, but like transaction
for sure.
costs and time invested and all these other things. Um,
Retail has an advantage because you can be in and out as much as you want. Like if you get a big bank and they've got 10,000 lots of E-mini, it's going to take a while for them to figure out how to get out of that position.
oh, definitely. Yeah.
And whereas you and I, we're trading one single lots, so we're in and out as much as we want. We can literally take the best trades every single day without having to think about it. They can't because they move the market. So,
They're
their edge is
clumsy.
that they've got tons of capital and they can just sit there and take a loss forever and then
Yeah.
eventually come back.
Yeah, if they were using their capital to sell the puts that I sell, then they'd be doing pretty well.
And that would change the market though too. So then you would see that reflected And so they
Yeah,
gotta
you're
kind
right.
of,
Yeah. They have
they
to
kind
deal
of,
with the stupid reflexivity issues and all
yeah,
sorts
yeah,
of
exactly.
messes.
So there's a lot of other issues that come with being a big bank. Yeah, they can cheat, and they can front run you, or they could put out news or get political that helps their positions. It's like, but none of that, that's edge that they have. That's not the same. We don't even care about that. All I care about is making $200 a day. I don't need to mess around with, you know what I mean? Like, I don't have to kill nobody to get paid. It's like, I just got to come in there and figure out how to make 5 points, 10 points.